Today we are diving into the secrets of wealth accumulation at any age. Unlock the secrets to maximize your wealth on any age and how to build your wealth through smart investing. In this video, we will uncover why low-cost investing is the key to unlocking financial success for the long term. So let's get started. Imagine you are looking to buy a car. Normally, you expect that the more you pay, the better the quality you get, like more luxury features and better performance. But when it comes to investing, it's a different story. You see, the more you pay in fees, the less you ultimately have in returns. So the important rule here is when you are investing in the stock market, it's crucial to focus on minimizing costs to get the most out of your investments. And many active investments firms will spin compelling marketing narratives to justify their higher cost. But my experience has shown that these active portfolios rarely deliver the promised higher returns. And I also show you some proof in this video. So the question is, how can you invest in the easiest way possible and still achieve great returns for the long term? Because the introduction of exchange-traded funds, otherwise called ETFs, are growing awareness of the benefits of low-cost investing. Index investing has become a global trend over the last several years with a large and growing investor base. How is this possible? And what are these funds doing differently? So to explain this, I first have to explain a zero-sum game. And while it may seem complicated at first hand, it's actually quite simple. You see, in investment terms, the zero-sum game refers to the concept that in every transaction there is a winner and a loser, and the total gains and losses net out to zero. This means that for every dollar gained by one investor, another investor must lose a dollar. It's important to remember that for every profitable trade an investor makes, another investor must take the opposite side of that trade and incur an equal loss. But then the important part, which makes a big difference when you think in terms of the zero-sum game. And that is, in a perfect world, investing will be like playing a game with no cost, where every dollar you gain is taken from someone else. But in reality, investing comes with expenses like fees, taxes, and other charges. These costs can eat into your profits, making it harder to win for you. So instead of everyone winning, these expenses puts the odds against you, making it tougher to make money in the long run, especially if you are frequently buying and selling. So let's make it more visual for you. In this figure, you will looking at two different ways to invest compared to the overall market. One option has low cost, shown by the red line. The other option has high cost, shown by the green line. Both investments reduce the chances of beating the market, but the high cost one does it much more. This means that after considering cost, investors as a whole end up with less than they started with. And the more you pay in fees, the worse it gets. And this is one of the most important reasons that you buy an ETF and hold it for a long time and don't try to buy and sell in the meantime. So after all, the economy will grow, represented by the underlying companies that are making profits. And since you are a shareholder in those companies, your returns come in the form of dividends. So when you invest in the entire market, you are essentially investing in thousands of companies. And by keeping costs low, you gradually accumulate returns over time. And when you have a higher expense ratio, you will see a lower return on the end. So the secret for you is this. Most investors have the best chance at maximizing net returns over the long term lies in minimizing these costs. In this figure, you see an example why costs are so important. So each fund has a dot on a graph where the cost of the fund expense ratio is shown on the horizontal x-axis and its analyzed excess return over 10 years compared to its benchmark is shown on the vertical y-axis. The straight line you see is the trend line, showing the overall relationship between expenses and returns for each group of its assets. You see that the higher the cost, the smaller the chance of your annual returns over a period of 10 years. And then you have the following group: actively managed funds. For investors who choose actively managed funds, the big question is which fund will do better? Because you want to have actively managed funds where they are trying to select the top 10 or 20 best performing companies, right? Maybe not, because many people try to answer the question which fund will do better by looking at the fund's past performance. But just because a manager did well in the past doesn't mean they will do well in the future. Researchers have looked into this for years. Back in the 1960s, Sharp and Jensen found that the past success didn't always continue. Carhart's study in 1997 also showed no evidence of consistent outperformance even after considering different factors. And more recently, Fama and French study in 2010 confirmed that it's really hard for active managed funds to beat their benchmarks consistently. And this is usually the case because active managed funds tend to have higher costs. So if you are smart and you want to invest the right way, you will invest in ETFs where you are broadly diversified against low cost. So keep investing.